We have a really interesting segment now when we're going to bring in Matt Stoller and David Dayen, who are going to debate in a really, I think, substantive, deep, interesting way what's been happening with the Federal Reserve and inflation in the last several months. So we're excited to bring in Matt and David.
This week, new hotter than expected inflation data came out, which has produced expectations that the Federal Reserve is going to continue ratcheting up its interest rates. There's been a kind of paradoxical response from the stock market in the last couple of days. The stock market shooting up rather than crashing, as some people expected that it might. We're going to be joined now by Matt Stoller and Dave Dayen, two friends of the show, who we're going to talk about the relationship between the Federal Reserve, policymaking, employment, unemployment, and started here by a tweet of mine that got Matt mad, which then led to this segment. So the housing market will totally crash, but with interest rates like this, only cash buyers will be able to capitalize more upward distribution of wealth facilitated by the Fed. And this was in response to somebody posting a chart showing that the average 30-year fixed mortgage rate had climbed to 7.14%. So Matt and other people pointed out, hey, you guys complain when when monetary policy is too loose and fuels inequality, and you say that's creating an upward redistribution of wealth. And then when monetary policy is tight, you complain that it's shifting policy up, and that in fact the increase in lending costs is actually going to hit a lot of rich people as well. And so we're gonna unpack all of that. And I think this is an interesting conversation because all of us, including Emily, want higher wages, want a competitive and strong economy. The question is how to get that, either given the tools that are practically available to us and also the tools that are legally and actually available, but political constraints keep them from being discussed. So, Matt, how would you describe kind of your thoughts about how folks like me think about federal interest rate policy, Fed interest rate policy?
Right. So over the last, I guess, 6 to 9 months, maybe a little bit, maybe about a year, the Fed has been tightening its monetary policy, which is to say it's been raising interest rates and shrinking its balance sheet. So taking money out of the banking system. And the result is that the stock market has gone down significantly. It's gone about 30% or so. But another result is that housing prices are starting to go down. Rent increases are finally slowing. Crypto has crashed. Mergers are declining. And meanwhile, unemployment is still at 3.5%. And you see help wanted signs everywhere. So what's effectively happening is billionaires are losing a lot of money, and Wall Street is losing a lot of power. It's not really touching ordinary people yet. We do have a serious problem with runaway inflation. So I think what I'm seeing here is that the Fed for the last 10 years has been pushing money into Wall Street. I mean, that's what the Fed does. It doesn't, when people say it raises or lowers interest rates, like Ryan, when you talk about that, first of all, it does more than that. But there is no one interest rate. It's not like your credit card interest rates go down when the Fed cuts interest rates. The Fed is simply lowering and raising interest rates for Wall Street, right? For like Apollo, the giant private equity giant, for Goldman Sachs and so on and so forth, but not for you. And this is deliberately put into statute. So it was in the CARES Act in 2020, which was the response to the pandemic. And what that means is that when the Fed prints money, and the Fed has printed about $9 trillion or so over the last 10 years, which at a run rate, if you just take an even run rate of how much the Fed used to print, it's about 900 years of money. What that does is it fundamentally distorted the economy over the last 10 years or so that we have garbage things like crypto. We have the dramatic expansion of private equity. You have nonsense speculation like GameStop and things like that. It's really reshaped our economy in incredibly dangerous ways. And the Fed is pulling back on that and starting to reverse that. And what we're seeing is the speculative hot air is coming out of the economy. A lot of the bad sectors that shouldn't exist, like crypto, are falling apart. Private equity is having real trouble financing mergers, which they use for arson. You're seeing fewer stock buybacks. This is good. This is getting rid of the financialization of the economy. Now, there is a serious danger. There is a risk of unemployment because what the Fed has done is it's effectively has the working person in a hostage situation, saying the only way that we can affect the economy is to give money to Wall Street or take money from Wall Street. And if we take money from Wall Street, then working people are going to get hurt. But that's a fundamental hostage situation. We now have a situation where we have runaway inflation. The only way to address it is to actually start pulling money out of Wall Street. That's what the Fed has been doing. It's a good thing. The problem is, and this gets to your question, the way the left thinks about monetary policy, they don't think about the distortions of the economy up there. They just think, oh, well, if the Fed gives money to Wall Street, which is not the way that they think about it, but they say if the Fed lowers interest rates, which is a much more antiseptic way of saying the same thing, then that's good for housing. It's good for working people. It's good for wages. And it's really not. What it's good for is the people who are getting the money, and it's good for warping our economy in really problematic ways. However, and this is to your point, if the Fed continues to pull money out of Wall Street, it will break the fragile financial arrangements that have been set up that are fundamentally toxic, but that are still what our economy relies on. It'll break those arrangements, and that will cause serious bankruptcies, unemployment, things like that, that it will cause real suffering. But that was sort of inevitable anyway. That's a result of the last 10 to 15 years of bad monetary policy and fiscal policy. So we are going to have to pay for what has happened over the last 10 years. And I think we should pay now. What we are seeing as the Fed tightens monetary policy is a lot of the speculative hot air is coming out of the market, and that is fundamentally a good thing. So that's my argument.
What is Matt getting wrong from your perspective, David?
Well, let me just say that I think Matt's brilliant, and I always learn a lot. I always learn a lot from him. I am going to disagree with him some in this case. First of all, if the situation was such that this increase in interest rates was actually bringing down inflation, then maybe this would be something that was, there would be a relationship where it would be positive. I see no evidence that the increase in interest rates is having much of an effect on inflation. Interest rates can't deal with the situation in Ukraine. Interest rates can't deal with continued waves of COVID in China. We're still seeing very high interest rates right now. It's not due to wage increases. Real wages are down. But interest rates continue, or inflation continues to be very high despite this continued ratcheting up. And as Matt says, it is going to have a cost eventually on the labor market. That is the explicit goal. That is what Jerome Powell has said he wants, is a softening of the labor market. And the ability, essentially, he's not saying it in these words, but the ability to throw people out of work and to increase interest rate. Some people like Larry Summers are saying it explicitly, that the unemployment rate needs to be 5% or more, which translates into millions of people losing their jobs. The idea that Matt has is that, well, we're going to have to pay the piper at some point, and this is taking money and power away from Wall Street. I question that to a certain extent. 2021 was a real outlier in terms of mergers and acquisitions. Let's just focus on that. It was the highest levels that we have ever seen, pretty much. But according to a report from DC Advisory, deal activity, at least in the private equity space, is going to hit the levels of 2018 to 2020 this year, which were the three previous highest yearly activity levels on record. It's not going to hit 2021 levels, but it's not like it's coming back to some some impoverished level. There's still about $3 trillion of what we call dry powder in the private equity markets, which is money that has not been deployed to buy companies. There's still plenty of room to run there. And the private equity industry is pretty skilled in figuring out ways to get out of trouble, even in an unfavorable environment for them. I would point you to this failing Citrix deal, which is a merger which is now going to cost banks a ton of money because they made the deal in a certain interest rate environment, and now interest rates have gone up, and they're going to have to spend a lot more to make this deal. The way that deal was structured, the private equity companies that were creating this merger with Citrix invested no new cash into the deal. And there were these preferred shareholders who were other private equity firms who allegedly made investments, but they have the right to claim all proceeds for the sale of one of the companies in the deal. The private equity is very skilled at figuring out ways to wriggle off the hook. And they're doing so with things like what are called continuation funds, which is they just sell companies to themselves so they don't have to realize the losses that they have on their various portfolio companies. So my point is that the idea that this is punishing Wall Street, I think, is a little bit dubious. I think there are ways in which Wall Street is relatively unaffected. And of course, when interest rates go up, banks do pretty well. They get to increase the interest rate that they charge on consumer loans. What we do know is that while housing prices are falling a little bit, the cost of housing, at least for mortgages, buying a mortgage, has gone way up. I mean, mortgage rates are at 7% right now. So the monthly payment, which is what matters here, is going way up. And that's why we're seeing activity in housing markets at levels that we haven't seen since everybody was sitting in their homes at the very beginning of the pandemic. So this is not good necessarily for housing. And the other thing that it does is it makes home builders say, this is not a good time to build, this is not a good time to create housing. And of course, the reason that we have distorted and unaffordable housing markets is there's simply not enough housing out there. And a situation like this creates less housing being built. This is the problem that we had directly after the financial crisis, when we had a decade basically of flat home building. So I don't think that's a positive necessarily for individuals either, because over time, this is going to create this continued gap in the amount of housing we need and the amount of housing demand that there is. It argues for a need for social housing or some other way to get out of this cyclical rut that you get when you rely housing on the public market. So those are some of my points.
And David, on that point, and Matt, curious for your response on this. You talked about a lot of kind of other policy levers outside of monetary policy that could improve these situations. And I guess from my perspective, I agree. Definancializing the system is something that is necessary to be done, and if this accomplishes it without destroying the labor market, that's great. From my perspective, what I would have liked to see, and maybe we'll still get to see it, is what can a tight labor market do to our politics and to our political economy if it's allowed to persist for several years. In other words, if you have workers who are empowered and becoming militant in the workplace, which you're seeing now, what does that look like? How does that change our politics? What do they start demanding? Do those workers then start demanding that the private equity be basically taxed out of existence? Because private equity absolutely benefits from this loose monetary policy, but they're also a regulatory creation of kind of the basically the Carter and Reagan era.
They benefit either way, basically.
Right. So you could just like they were created by policy, they could be uncreated by policy, and also by marginal tax rates that make speculation in crypto, make all of the bubble financialization stuff that you're talking about, that makes that impossible. Right now, there's no way we're getting marginal rates up there. But what if a tight labor market persists, creates a labor movement, and then is able to fix that?
What they start demanding is a Republican Congress. That's what they're demanding. Like, what people want is to deal with inflation. That's just what people want. And I know it sounds callous that Larry Summers says we need to get rid, we need the labor, we need fewer jobs out there. But like, that's what people want. And like, we just sound like idiots pretending that inflation isn't this massive problem and that we don't want millions of people thrown out of work because it sounds mean. People are saying their main problem is inflation. And like, we just sound like morons by being like, oh, this is good for labor. And like, working people are saying, we don't like this situation. That's just the reality.
What about
the Fed is not,
by the way, I just want to mention, so
the Fed is not helping the inflation situation.
Well, I mean, okay. First of all, I think there's a difference between raising interest rates and shrinking the balance sheet. So I want to talk a little bit about that because increasing the balance sheet, right, was explicitly about the Fed going in and buying financial assets, particularly risky financial assets, like the risky loans that private equity firms would need to finance their takeovers and other sort of stuff out there. And because they were, kind of going out to the edges and sort of pushing and forcing investors to go down the yield curve and buy riskier stuff, it incentivized much more speculation. So we're not just talking about raising or lowering interest rates. We're talking about financial operations where Federal Reserve traders would go in and buy specific assets. And I think that's really dangerous because it is actually having the Fed sort of doing fiscal policy, which is the purview of democratic institutions. So I just want to put that on. I want to distinguish between those two things. The other point is the Citrix deal was negotiated in March when we were still in this like crazy moment when there was basically free capital. You would not see banks negotiating a Citrix deal or PE firms doing a Citrix deal today. So I just want to point that out. Like
I think Elon Musk's purchase of Twitter is like a Citrix deal.
He's trying to get out of it for that reason. He sought to buy it when the market was frothy, and now he's trying to get out of it. And the banks are going to lose a lot of money on that debt too. But that's because they committed to it in March, April, May. I forgot exactly when he said he was going to buy it. There's no way that acquisition he wouldn't put forward that acquisition today.
And that's possible. Literally this morning, Kroger and Albertsons are combining.
No,
the idea that there's that there's this trough of activity in M&A and in PE, I just don't think is true.
Look, there absolutely is. You said there is. The 2021, but first of all, it was not an anomaly, right? It was a record, but it was a record because we passed a law in 2020 called the CARES Act, which said the Fed is going to buy risky assets. And my organization came out and said, you wrote about this, and Elizabeth Warren talked about this. This is going to fuel a merger boom, and it indeed did that.
And it did.
And it did. And now the thing is about projections, right? When they say, oh, private equity is going to go back to 2019 numbers, which of course is too high. These are projections, right? And one of the things that's happened is that the projections have been consistently wrong and overestimated activity. Now, I think we can all agree that we would prefer to go back to a world where we had a competent government that was managing markets in a much more deliberate way, that we could push money and actually build more housing, that we could get rid of this financialized economy without having to kind of crush the labor market. We could have, we could organize things the way that we did in the Depression, in World War II, and in the 1950s, where you just had a lot more analysis and understanding of our markets, and we wouldn't have semiconductor shortages and all these different things. But that's not the world we live in. Like, fundamentally, we've been making the argument, I say kind of collectively for the last 10, 15 years, that we need more government competence and more deliberate management of markets. And we're starting to have some impacts, but we have not succeeded in building that infrastructure yet. All we have is the Fed. And that sucks, okay? It's a bad situation, but it is reality. That's all we got. And we got inflation now, and it's, and we all know that it takes a while for the Fed to, it takes a while for like monetary policy to hit the economy. I would have preferred a lot of other stuff. I was talking about shortages in February of 2020. We didn't do any of the things that we needed to do. So this is all we got. right? And inflation is a huge problem. Unemployment just isn't. We have got to be serious about where we are. And you also have to look at Wall Street. The stock market, the bond markets have collapsed. You cannot tell me that this has not had an impact on billionaires in Wall Street. The ability to finance deals is much lower. And yes, you can point to deals, important deals. We definitely need a revamp of antitrust policy. You guys know I care about that and want that to happen, and it's sort of in process. But the reality is, this is all we got right now. This is the only lever we got. So we got bad choices on both sides. And I'm saying it is a better choice to say, let us stop the party on Wall Street. Let us stop the carnival. Let us stop amplifying asset prices, which includes housing prices, and start to take them down. And that is what is happening. And it's causing a lot of pain. Obviously, 7% mortgage rates. It's terrible if you're trying to buy a house. But the reality is, the reason for that is housing prices skyrocketed because of Fed policy. And when you start to fix things, it's really painful. But the alternative would be housing prices continuing to go up at 10, 20% a year, which is not sustainable and is much worse. So we got to be serious here about and look at the world from the perspective of the billionaires and not just say, oh, well, people are getting wage increases here and there when real wages are actually going down and have been for the last year or so.
Last word to you, David, quickly.
I mean, I agree that it's a bad situation. I'm glad you agree with me that it's a bad situation what the Fed is doing.
Yeah, I think that, yeah.
And it does take time to move through monetary policy through the economy, and that's why the labor market is still, unemployment is still at 3.5%. But nobody believes that what the Fed is doing is going to leave the labor market unaffected. I mean, we already saw in the last the JOLTS report.
What's your alternative?
We saw that open positions fell by 1.1 million jobs in the last month. So we're heading in that direction. We are heading toward a recession. It is true that the loss of, say, 5 million jobs relative to 300 million people experiencing inflation, it's always going to be the case that more people look at that inflation and say, I don't want this. But that doesn't mean that for those 5 million people who are going to experience a depression, and for the millions of people who are going to experience a recession and have all of the attendant problems associated with that, that doesn't mean that that's that there's this sort of John Stuart Mill greatest good for the greatest number situation going on.
Well, David and Matt, there's a ton more to say on this, and we want to have you guys back. But all right, we'll give you 30 seconds, but we're not going to get the show out on time, so we got to do this quickly.
What's your alternative? Like, should the Fed continue the speculative boom, or what's the alternative here?
I think the alternative is dealing with this in a more holistic way, with using the power of Congress to deal with the real drivers of inflation. I'm not convinced that the Fed is dealing with the real drivers of inflation just by crushing demand. Mm-hmm. There are supply side issues, there are corporate profits issues that you've written about, and I don't think that what the Fed is doing gets to that.
And the Fed can't make it rain in California, so.
That's
but
true.
we'll talk more about this next week after. Want to have you guys back on to continue this conversation.
I'll come in and talk about the gold standard.
There you go. Excellent. Perfect.
Great.
So Matt Stoller, American Economic Liberties Project. What's your Substack?
It's big.
Big. And Stoller, also a contributor here at the Breaking Points channel. Right. Dave Dayen, editor at the American Prospect. Thank you guys so much for joining us. A programming note for next week.
That's right. Big programming note.
We'll be here on Monday and Tuesday. Crystal and Sagar are going to be out. They'll be back after that, and then we'll be back again on Friday for Counterpoints. Right. If you were very confused, our Counterpoints Friday airing on Wednesday was a unique thing for a holiday weekend. But we'll be here Monday and Tuesday filling in for Crystal and Sagar.
We're excited. We already have like half of Monday's show planned. So
my stuff that got bumped from today.
Stuff that got bumped from today. Good, interesting stuff.
And it'll get bumped probably.
Probably. so pessimistic. And reasonably so.
Yeah. All right. Well, everybody have a great weekend. See you soon.
We'll see you Monday.
Cable news is ripping us apart, dividing the country, making it impossible to function as a society, and making it impossible to know just what is true and what is false. But the good news is they are failing and they know it.
That is why we're building something new, a new mainstream, a healthier one, something more trustworthy, something that we are going to need in one of the most pivotal times in American history. We are building up here for the midterms, for the upcoming presidential election, but we need your help. So if you can help us out by becoming a premium member today at breakingpoints.com, we're trying to change America for the better and the entire world.
So what are you waiting for, guys? Go to breakingpoints.com and sign up and help us build a new mainstream.